Hey y'all, it's Dave Parrott, the Fund CXO and founder of Signal Fund Services. Today, we're going to continue our series on the minimum viable venture fund operations by talking about what does proof of concept mean from an LP's perspective. Now, in today's episode, we're going to follow on from prior where we talked about the maturity curve venture fund, the different milestones and pathways that they take. Now, reminder, first fund is usually a proof of concept where you're showing LPs that you can actually execute on the strategy that you shared with them. You can build this basket of assets. Fund two is about operationalizing and scaling your investor and product market fit, building out the team, the deals, the LPs that you need to win. And then ultimately, fund three on your path to raising institutional capital is an opportunity to establish your differentiation and show how you fit into those institutional LPs' broader portfolio. So, what does proof of concept actually mean? And there's a general rule of thumb, right? If you can imagine, fund one, you are showing to your LPs that you can put together a basket of assets that's the same check size, and industry, and ownership, and ultimate underwriting and exit value of what you told LPs when you were fundraising, right? So, we made a plan together. I'm showing you that I executed on that plan. Now, Fund Two is generally considered raised on the execution of Fund One. If Fund One goes well and you build a good basket of assets, Fund Two is a little bit easier to raise. And if you can imagine, you get through the investment period of Fund One, you get through the investment period of Fund Two, Fund One is now mature such that when you go out to raise Fund Three, we can actually look at some of the results from Fund One. So that's why you might hear people say Fund Three is raised on the results of Fund One. Now, proof of concept from an LP's point of view, they're trying to assess a couple of things, right? Do you have the skill set that matches with the part of the market of which you're operating in? Do you have that investor market fit? They want to make sure that you've got the skill sets, the capacity, the capability to where you're trying to play. They're also trying to make sure that not only can you put together this basket of assets, but that you can manage the business around it, right? You are starting a new business, and from 0 to 1 in any startup, there is quote unquote chaos to be managed. There's people to hire and train, new systems to build, new tools to implement. There's a lot to do in a fund one. And so showing your LPs that you can walk and chew gum at the same time, that you can build great assets and that you can manage an investment management firm is critical as you move on in the path, right? Because ultimately, what you're asking LPs to do in Fund Two is say, I've got my results from Fund One. I've shown that I can manage this. Please give me more complexity, more to manage. I can handle it. People, more deals, more companies, more of everything. And so Fund One is about showing investors that you're ready to continue to grow. But they have a limited view into your operations. They're limited partners. They can't manage day to day with you. And so if you think about the way that they engage with you, the limited, narrow viewpoints they have, it's an initial due diligence when they get to ask a bunch of questions and see some information and data. It's during annual meetings when they get to engage with you personally, meet the founders, and share value with other members of the network. And then ultimately through your quarterly reporting and how you share information, manage things like a co-investment program or opportunistic SPV launches, right? So you think about the way they view you and what you're trying to show to them. You want to show them you've got the business covered and that their money is safeguarded. You're a good steward, that you're running a good ship and being a fiduciary. You want to show them that you make good, diligent decisions and that you're deliberate with their money, and that as you're building, you're learning and you're trying to institute repeatable processes to help with scale. And a lot of that in venture funds is information management, data decision makings. So how do you think through that? How do you manage it all? How do you actually make good decisions? And lastly, how do you share that? How do you communicate? They care about the quality of your LP reporting. They care about being able to access your data room and find what they need quickly. They want to be shown great deals in co-investment. And SPVs are just another opportunity to prove that you can handle this increased complexity as your business grows, right? So make sure that when you're building, you stop every once in a while and think about, from an LP's perspective, what am I trying to do here? And am I actually showing the proof to the right people? And if you got questions on this, we're here to help. Dave at signalfundservices.com, or connect on LinkedIn. We'd be happy to help and share what we're seeing, best practices and other industry standards, helping everyone raise that next fund. Talk soon.